Hi, and welcome to Lesson 3 of the Value Investing Bootcamp. I hope you are learning a thing or two from this course. Today we cover some of the most common reasons why people lose money on the stock market and how you can avoid these traps to achieve the investment success you are aiming for. Let's dive right in. In the previous lesson we learned that the main reason why many advisors and professional money managers generally don't earn impressive returns is because they suffer from a short-term relative performance orientation. The same goes for individual investors, although the reasons are slightly different. Where advisors and money managers feel the pressure to perform every single reporting period, the short-term orientation of individual investors is primarily caused by emotions of fear and greed. These emotions of fear and greed are the driving forces behind short-term stock price movements and are the result of pessimism on the one hand and hype on the other. Everyone wants quick and easy gains, but the truth is that there is no shortcut. Growing your wealth takes time. Every investor knows that to be successful, you need to buy low and sell high. But the reality is that hardly anyone does this. When prices are rising, investors get greedy and buy stocks because they don't want to miss out. When prices are declining, investors get scared and sell their stocks in fear they will fall even lower. The following graph shows nicely why this behavior will absolutely destroy your returns. The main cause of hype and pessimism is news. Investors are constantly bombarded with financial and economical news, the latest analyst predictions, and hot stock tips from blogs and gurus. The investment world has turned into an ecosystem of distractions. In today's internet age, we have more information available than at any point in history, but this makes it very hard to stay focused on your strategy, and you risk getting caught up in the general feeling of euphoria or depression. Let me give you the very best way to avoid this risk. Ignore the news. Ignore the news, but what if interest rates go up? What if a war breaks out, or what if Obama turns out to be Chinese? These are all valid points, but the fact is that all of this is out of your control. You have exactly zero influence over any of these issues, so it makes no sense to worry about them. They will happen with or without your consent. The good thing is that none of this really matters in the long run, because as long as you stick to buying great companies at discount prices, you will make a handsome profit eventually. You don't believe me? Well, the S&P 500 has returned around 10% per year since 1926, despite the fact that there has been a Great Depression, a world war, a dot-com bubble, and countless other dramatic events. Of course, it is very scary to see your stocks decline in price, but a price decline in itself is not a valid reason to sell. If anything, it should be seen as an opportunity to buy more of a great thing at an even lower price, assuming that the price decline is caused by fear rather than a fundamental problem with the underlying company. Buffett's most famous quote is possibly, "Be fearful when others are greedy, and greedy when others are fearful." What helps for me is to look at investing the way I look at buying physical products. Let's say I need a new laptop. I do some research and find one I really like, which costs $1,000. The price seems a bit high, but when I go back to the store the next day, the price has risen to $1,100 due to high demand, which is 10% more than the day before. In this case, would you be more willing to buy the laptop or less willing to buy the laptop at the higher price? Your emotional reaction might initially be to say more willing, because the price might rise even further. But the logical thing to do would be to look for a similar laptop with a lower price tag. Or, if you are not in a hurry, wait for the price of this one to fall. It is the same with stocks. A rising price is not a reason to buy. In fact, it is more often a reason to look for a better opportunity elsewhere. Legendary fund manager Seth Klarman had the following to say about this. Rationality that is applied to the purchase of electronic or photographic equipment is absent when it comes to investing. Let me give you one major tip which will help you stay out of trouble. Do not get emotionally involved. I'm not talking about relationships, but I'm talking about being largely indifferent to which companies you want to own. Investors generally lose money because they do not buy stocks that are healthy and cheap, but stocks which grab their attention. Wanting to own a stock just because you think it is a cool company, or because the company gets coverage in every single news outlet, is an emotional reaction and will get you in trouble. It should not matter to you if the stock is called Google, Tesla Motors, or Pooh Inc. All that matters is what the numbers and facts are telling you. Is it a financially strong company selling for a bargain price? Great. If not, move on. No matter how hyped the company is. Because the fact that other people are willing to pay a certain price for a stock does not mean that you should be willing to pay that price. And the fact that a company creates cool products does not necessarily mean that they are generating huge profits. In a later lesson, we'll go deeper into how your mind can work against you in making the right investment decisions. But for the sake of this argument, it is sufficient to know that news can create hype and pessimism, which leads to fear and greed, which in turn leads to irrational investment decisions that have a detrimental effect on investment returns and are the main reason why most investors lose money on the stock market. The key is therefore to block out most external news sources, to think for yourself and not get caught up in herd behavior, which is so common on the stock market. Going along with the crowd feels safe, but it ensures mediocre returns at best. Besides fear and greed, another reason why investors often fall into this trap of buying high and selling low is that the terms low and high mean nothing unless they are put in a correct context. A price should only be considered low or high relative to the value of the underlying company, not relative to the price of 1 minute ago or any other previous price point. For example, buying Apple stocks at $70 purely because they traded at a price of $100 1 year earlier is silly. However, buying Apple because, through fundamental analysis, you estimate the true value of the company Apple to be around $100 per share is the value investing approach. You could argue that the net result will be the same in both cases, and you are absolutely correct. But what if we take a hypothetical company whose price movement has been identical to Apple's, but whose value is much less than its current share price? How could you tell the difference if the price chart is the only thing you would look at? That's right, you can't. The price might be low relative to historical prices, but this tells you nothing, because that previous high of $100 might have been caused by irrational behavior, powered by hype and greed. So focus on low prices, but only relative to value, not relative to previous prices. This is where many investors go wrong and lose money by having the illusion of buying something cheap, while it in fact might be significantly overpriced relative to value. This means that technical analysis, which is analyzing stocks purely based on historical prices, is something you should avoid, and Warren Buffett agrees. I realized that technical analysis didn't work when I turned the chart upside down and didn't get a different answer. The final reason why many investors lose money is because they trade too often. This leads to enormous transaction costs. Many people might not realize this because transaction costs are often only small fees. However, they do add up. If you remember the example of compounding interest from lesson 1, you know that the difference in return of just 1% can result in tens of thousands of missed dollars over the course of several years. To make things more tangible, take this example. Investor A and B both invest $10,000 and earn 20% a year. The only difference is that investor A trades once a month, while investor B trades once every quarter. We'll put the cost of one transaction at $10. The result after 20 years is a difference in wealth of almost $15,000. This is a huge difference. So make infrequent, big investments rather than frequent, small investments. In the words of the highly respected psychologist Daniel Kahneman, all of us would be better investors if we just made fewer decisions. Wow, we covered a lot in this lesson. Let me summarize the main points for you. Just like advisors and professional fund managers, individual investors suffer from a short-term relative performance bias. Fear and greed are the primary drivers behind short-term price movements. Growing your wealth takes time. There is no shortcut. Many investors buy on hype and sell on pessimism, which absolutely destroys their returns. Ignoring most of the financial news is a great way to stay out of trouble. Be indifferent to the stocks you want to own. Let the numbers and facts determine your decisions instead. Think for yourself and try not to get caught up in herd behavior. A stock price should only be considered low relative to the value of the underlying company, not relative to the price of a previous point in time. Frequent trading leads to high transaction costs, which has a huge impact on your total returns. So make infrequent big investments rather than frequent small investments. Okay, next lesson is already the last one of the introduction module. It will be an exciting lesson because I will help you determine your investment goals. Great job so far. I see you in the next video.